In the current market, certain high-end consumer goods are yielding returns rivaling traditional financial safe havens. For example, over a 10-year period, the resale value of a stainless steel Rolex Daytona has consistently outpaced standard market growth. Similarly, specific designer handbags, like the Hermes Birkin, have historically held their value with more stability than physical gold. Most people view these items as symbols of status, using their capital to buy a look. The wealthy view them as an asset class, a way to diversify their wealth into objects that appreciate while they're being held. We are going to reverse engineer this strategy. Using a starting balance of just $1,000, we'll build a portfolio that mirrors the alternative asset holdings of the ultra-rich. A vintage Ferrari F40 is $1 million asset, which makes it unreachable for a $1,000 budget. However, you can now purchase a specific percentage of that vehicle. Fractional platforms like Rally or Masterworks acquire these rare collectibles and register them with the SEC as individual securities. They then split the asset into shares, allowing anyone to buy in for a fraction of the total cost. This works because of non-correlation. These assets don't move in tandem with the S&P 500. If tech stocks crash tomorrow, the cultural value of a Banksy mural or a Picasso remains largely unaffected, shielding your capital from broader market volatility. The trade-off is illiquidity. Your money is effectively locked in place until the platform decides the market is right for a full sale, which can take years. Given that your capital is trapped, the baseline rule for this strategy is to allocate no more than 10 to 20% of your starting portfolio to fractional assets. If you cannot afford the luxury product, you buy the producer. This chart compares the 5-year growth of LVMH against the S&P 500. By owning the parent company of brands like Dior and Hublot, you profit from the global demand for luxury without the risk of owning a single physical item. This approach essentially turns luxury consumption into an investor dividend. Every time a billionaire buys jewelry or high-end goods, they are contributing to your portfolio's growth. The primary risk here is cultural shift. If a single brand loses its appeal, the stock suffers. To mitigate this, we use exchange-traded funds, or ETFs. An ETF holds a basket of different luxury companies and weaves them together. This provides instant diversification and high liquidity, allowing you to enter or exit your position at any time. Before we move on, consider this choice. Would you rather have the social visibility of a $10,000 Rolex or the financial leverage of $10,000 in luxury equity? Let us know in the comments. This leads to the core principle of capital preservation. The wealthiest investors rarely fund their lifestyle or luxury purchases using their primary capital. Spending your principal on a depreciating consumer item means that money is gone. It will never work for you or compound again. Instead, deploy that capital into broad market index funds. These assets act as the foundation of your portfolio, working continuously regardless of fashion trends. These unglamorous holdings generate predictable cash flow through dividends and the long-term growth of the global economy. The goal is to build a base that stays intact forever, allowing you to use only the passive income it generates to eventually pay for the luxuries you want. Here's the allocation for your $1,000. First, put $100 into the fractional market for collectibles. Second, allocate $400 into luxury stocks or ETFs for industry growth. Finally, place the remaining $500 into an index fund for foundational yield. Remember, the foundational index fund is the most important step. You should never buy a fraction of a Ferrari until your core portfolio is generating growth. To learn how to set up this automated foundational portfolio in under 10 minutes, click the video on your screen right now.